It's no surprise this session is about setting a target, and specifically a gross profit target. But before I get onto the detail and just straight into how you set a target, I just want to share a brief story about my background and really where my obsession with setting targets comes from. So the story is going to be about 8 minutes long, and then the rest of the session will be about 25 minutes long, and then there'll be a Q&A afterwards. So back in 2012, I'd been with a family business for about 8 years. You can see I was a lot better looking back then, much less stressed and a lot happier than I am today. But during those 8 years, I cut my teeth rebuilding engines. So I am a qualified technician, and I was rebuilding K-series head gaskets, etc. Probably engines you're probably all familiar with. But it took about 8 years before I started to show any interest in the way the business was operating whatsoever. Probably because I wanted a pay rise. It's a family business. Working for those that have worked with your dads and family, you know how difficult that relationship can be. And during that 8-year period, I saw the business very successfully grow from 1 member of staff, my dad on his own, up to about 10 members of staff. We achieved a turnover of about £1 million. So from the outside in, it appeared to be a very successful company. And it was a successful company, but it wasn't without the cash flow problem. So every now and again, we'd get caught out by a cash flow problem, probably a familiar feeling to some of you guys. And it always seemed to take us by surprise. And this ranged from having to juggle suppliers at month end where you can't quite pay everybody at the same time. So I remember one particularly bad instance was we had to pay the VAT on personal credit cards, which is not a nice feeling. Now, how is it possible that in a business that is seemingly so successful, fully booked, busy all the time, great team around us, how is it that we've got cash flow problems? And that's a feeling that I hope resonates with some of you guys. So to get to try and understand why there is this cash flow issue, I set a meeting up with our bookkeeper. So we had a bookkeeper at the time. She essentially did data entry once a week, and then she produced a set of management accounts. Now, I didn't know anything about finance at all when I set this meeting up, but I very quickly learned that our bookkeeper also knew absolutely nothing about finance, because she couldn't answer any of the questions that I had. And one of the questions was, if we're showing a profit, which we were every month, we were showing a modest profit every month, then where is the cash? Why are we not building up cash even though we're profiting? Now, I'll talk a bit more. I'll talk a bit more about the difference between cash flow and profit later in this presentation. Now, in hindsight, the answer is obvious, but even if you know the difference between profit and cash, it's really difficult to report on. Off the back of the meeting, I made genuinely one of the stupid decisions I've ever made in my career. I went and bought this book. I read this book cover to cover, and then made the decision that I'm now going to be a bookkeeper for the company instead of a mechanic. Between 2012 and 2014, nothing changed. I took over the bookkeeping. I was now just data entering, producing really poor management accounts. Didn't change anything, didn't improve anything. And in 2014, we completely and dramatically ran out of cash. I don't regret learning how to bookkeep, because there are some valuable lessons in bookkeeping, and it's what led me to what I know about accountancy now. But what I actually did was make the situation for Lindley's way worse, because I went from productive to non-productive. And I speak to lots of business owners about bookkeeping, and they feel like they need to do their own books or learn how to do their own books. It's just something I strongly recommend against. Grant, I'm looking precisely at you. Now, before we ran out of money, we did manage to expand twice. Luckily, it was through gut instinct and hard work, to be honest with you. Now, luckily for us, the first expansion was an absolute goldmine. This is the branch in the top right-hand corner you can see now. It's our head office. It's the branch that a lot of you have actually been to. To be honest with you, it was much more luck than judgment. It was fully staffed, really good customers, really good work. It would have been a challenge to actually get that one wrong. But what that actually did was, when we decided to expand for the second time into our third site, we were completely overconfident, completely underprepared, very naive. Now, the difference between these two sites is one is a blank canvas and one was an existing business. I've spoke to lots of you about expansion, and one of my best piece of advice is try and buy an existing business. Don't start from scratch. Sean, I know you've been through that. It's very, very challenging to do. Now, when we expanded for the second time into the third site, it was a matter of time before we ran into trouble, because unbeknown to me, the company was fundamentally flawed at that point, but I didn't know it. I had no understanding of costs. We didn't have a viable business. It didn't matter how hard we would have worked, the company was destined to fail. And 6 months after we opened those doors, it started to sink in that we are now in some serious financial trouble. The fundamental problem is that the third site was losing a lot of money, which in itself is not the issue, but we had no plan to lose money, and we had no plan on how long we need to lose money for. And any new business and expansion needs a plan. And what made it worse for me, and this is coming on to why we set a GP target, because I was relying on bank balance. Now, you're probably all as business owners aware of how your business is performing based on your bank balance. But during this expansion, some things happened that made the bank balance completely unreliable. So you imagine as we grow, you spend more with suppliers, you have more on credit, bolsters your bank account, you've got more cash in your bank. We extended payment terms, so we had more credit, which resulted in more cash in the bank. But more importantly, we were selling more. So sales were up, so we had more VAT money sat in our bank account. So all of those things combined meant that the pattern of the cash flow through the bank had changed. Now, everybody sat here, you probably know in a month how much cash you need to get through the month, or in the quarter, how much cash before your VAT you should have. But because that pattern changed, my gut instinct completely failed. And I still to this day vividly remember sitting at my desk and it dawning on me that we can't pay the suppliers. And I'm not just talking about juggling the suppliers. I mean, there's no chance we're going to be able to pay the suppliers. And what made it even worse was the following month the VAT was due. So who do you pay? Your suppliers, or do you pay the VAT man? Both have serious repercussions if you don't pay. This essentially happened because I was buried in the day-to-day operations with no target. I didn't know what a good day looked like. I was looking at my bank balance. I was looking at sales. Sales were great. We were growing, but I had no idea what an actual good day was. And all this happened because I decided to take over the bookkeeping and made no improvements at all. As a result of all of that, I had to call a meeting with the directors. I had to explain to them the problems, which they were totally oblivious to. So there were 3 other company directors at the time. The company felt good, staff were happy, customers were happy, we were growing, everything felt good, but there was this undercurrent of cash flow which was catching up with us. We agreed that we weren't going to pay the directors at that month end, which I was very thankful to the directors for. And the short-term solution was to extend the overdraft. So we plugged that immediate cash flow gap by extending the overdraft. We had the option to remortgage if we wanted to, but who wants to pour their own personal business money into a business where you don't understand why it's losing money or where it's leaking from? And had we have reinvested back into the business, the fundamental issue was still there. We were burning cash with no plan on how to stop burning cash or how long we needed to burn the cash for. And really, this was the wake-up call that inspired me to, I've got to get a grip of reporting. I have to understand on the day-to-day basis how we're actually performing financially and from a performance perspective. And that's what set me on the path to simplify the reporting, both from a financial perspective and from a performance perspective. Now, obviously, we managed to get through that. That was the trickiest period, apart from COVID. That was the trickiest period that I've had in business. But 8 years on, Lindley's has gone from strength to strength. We've now gone from 3 locations to 10 and nearly 100 staff. But the point of the story is that the cool thing is that the method that we started to use back then is the same fundamental method that we're using today. And it's the reason why I personally think that you really can't run a business or a garage without knowing what GP target you should have. If you come to me for any advice, I start there. Understand your GP target, intimately understand your GP target. Now, the really good news for you guys is I actually went through 2 management systems before I got to Garage Hive, and I was still managing to do it by extracting the data, manipulating the data in Excel to give myself GP to benchmark against the target. The good news is for you guys is that Garage Hive and Power BI make it really, really simple to do. So if you're not utilizing Power BI to know what your GP is against your target. I hope at the end of this session you really, really are engaged with it, because it is genuinely game changing. So that's my life story over, and now we're going to move on to the objectives of this session. So just going to quickly run through this. So we need to learn why a GP target is critical to your business. I hope my story's done some of that, but there is more later on in this presentation. We need to mathematically gain a fundamental understanding of how Garage Hive calculates GP. I don't want to teach anyone to suck eggs, but we've got to all be on the same page. It's slightly different to some other systems. We need to learn how to set a gross profit target and model, and then we're going to model your business around the GP target. Again, it's not just about understanding day to day how you're doing, but it's about, have you got plans to expand? Do you want more staff? Do you want to spend some on marketing or invest in some tools? With a GP target, it makes it really easy to create a business plan around it. To do all of this, though, we need to do a cost analysis. It's not a glamorous job. It is quite boring, but it is game changing once you've done it. And then I'm going to show you the new feature in Power BI, which Sean was talking about earlier. It is a really cool feature to understand how you're performing financially. So from this point, we'll be about 25 minutes. I really do hope there are questions, and I'm in no rush to get away at the end. So I'm happy to answer a talk as long as you want me to. But if you could save your questions to the end, it just means that those that want to get through the content aren't hanging around longer than necessary. So going back to my story then, there really are 4 fundamental ways outside of GP that you can monitor your business, and you're probably using a combination of these 4 if you're not using GP. So your year-end accounts, if you're a limited company, you'll be familiar with this. It's the clues in the name. You get it once per year. It's a complicated document to understand. Your accountant will hopefully come and visit you, talk a load of nonsense to you that you don't understand, and if you've had a good year, you'll get a tax bill at the end of the year. They aren't much use outside of that, to be honest with you. Profit and loss is a great document to understand financial performance and financial health of the business, but it's not very good at monitoring performance of the business, and I'll explain why in a couple of slides' time. Bank balance, if any of you sat here are using bank balance to understand how you're actually doing, this presentation really is for you. You have to stop doing that. You will eventually you'll run into trouble. And if you've got any ambition to expand, bank balance is a really dangerous way to judge if those decisions are good decisions. And sales isn't bad to monitor performance, but you don't know what your margin is when you're looking at sales. So you could sell 16 tires, have really high sales for the day, think you've had a great day, but actually your gross profit's terrible off the back of those tire sales. So sales isn't a good one. So what are the benefits of reporting from gross profit then? So because of Power BI, it's immediate. You know at the end of up to 8 times per day, but I only recommend you look at your GP at the end of the day, even though I know some of you are that obsessed. Look at the end of the day, but it's immediate. It's very simple to understand. You have a GP figure and a GP target. Take one from the other, you've got your net. It's much more accurate across all timescales. So from a day, a week, a month, etc. And the way that we train to set a GP target is actually really good for cash flow as well. And cash flow is the hot. I would hazard a guess that no one in this presentation does a cash flow statement. But this GP target is a really good way to understand cash flow. Right. So mathematically, then, what is gross profit? So this is how Garage Hive calculates this. Again, I don't want to teach you to suck eggs, but we've got to understand this. So there are 3 jobs here, and then the totals. So in job 1, we've got labour sales, parts sales, and total sales of £900. The costs of goods sold on that job are £300, so the GP is £600. Really simple. Sales revenue minus the cost of the parts sold equals GP. In example 2, it's labour only. There are no parts sold, so there are no costs of goods sold. So it's £80 worth of sales, which is £80 worth of profit because there is no cost of goods sold. In the 3rd example, it's a warranty job. That's a fault warranty job. It's a fault of the business. The business has done something wrong. Therefore, there are no sales to the customer. You've had to rebuy the parts. The cost of those parts are £450. So you've lost £450 on that job, minus 450 GP. You run your end of day summary report. All those jobs combined, you've got a total sales of £980. A total cost of goods sold of £750, which means your GP for the day is £230. So hopefully we now all understand exactly how Garage Hive is calculating gross profit. Now, on that previous slide, I said I used the term cost of goods sold in each one of those jobs. Now, this is a very boring topic that I get excited about because it fundamentally changes. Well, it really adds to the benefit of using Garage Hive, and there aren't many systems using this method, and this is the only method to get an accurate gross profit figure. So COGS stands for cost of goods sold. So COGS is an accounting method. And essentially what happens is the system that you use takes into account the cost of the part that you've sold on the day that you sell it, not on the day that you buy it. So if you're using Sage or Xero, probably both of those systems aren't using COGS, whereas Garage Hive and Power BI does. So I'm going to show you a transaction. It's an extreme example, but it's just going to demonstrate the difference between COGS and not using COGS. So on the 17th of January, you buy an engine for £8,000 and you sell it in February for £10,000. So it's a transaction that's quite realistic. It can happen, and it can cross the end of a month. So if you're not using COGS, so you're using Sage or Xero, this is how they will demonstrate this transaction on your profit and loss. You buy the engine in January, and Sage will put all of the cost in January because it only understands when you buy the part. It doesn't understand when you sell the part. And then you sell the engine in February, and it puts all of the revenue in February. So if you're looking at a profit and loss, it's got all of the cost in January and all of the sales in February. So if you're making performance-based decisions on those months, January is going to look absolutely awful and February is going to look absolutely brilliant because of one transaction. Now, what Garage Hive and Power BI does is when you buy a part in Garage Hive, it actually puts it into stock. If you think about the financial position of your business, it hasn't changed. You've just swapped credit for an asset, so the value of your business is identical. So in January, it doesn't assign any cost. However, when you sell the engine in February, it knows the cost of that sale. So then it applies the £8,000 cost to February. So you can see in the second example in green using COGS, you've got a much more accurate profit and loss representation, which is why there is a fundamental problem with some profit and losses and why GP is so much more accurate across timescales. I hope I explained that well enough. Okay, so now there is another thing to consider with a profit and loss and why GP is better as well. So if you look at this is essentially a profit and loss for 2 months, January and February. And if you look at the GP for each month, it's almost exactly the same. You've got 34 grand GP in each month. And that's made up of 52.5K sales each month. Total cost of goods sold in each month of about 18 grand. So the GP for each month is about 34.5 grand. And if you were using a profit and loss, you would look at both of those months and think they're 2 good months, similar in performance. But there is a big difference between January and February. If you look at the top in brackets, January's got 22 working days, February's got 20 working days. So the output available in January, you times 5 technicians by 8 hours a day across 2 extra days, it's a significant chunk of output available in January that's not available in February. Again, a profit and loss doesn't consider working days. It doesn't care about how many days there are in a month. And you start throwing in extra bank holidays, and it really does start to have an impact on a profit and loss. When we set a GP target, we set the target based on the number of working days. So the months with more working days have a higher target to compensate for the months with less working days. So when you're actually looking at your GP against your target, you actually understand how well you performed on a day-to-day basis, regardless of how many working days there are in a month. It makes on a P&L, I promise you, some months you'll only profit because it's got extra working days. And some months you'll only lose. Take December, look at all of your profit and losses in December, you'll probably lose money because they're normally much shorter than March, for example. Now, it's not all bad for a P&L. A P&L definitely has its place in a business. The problem with a P&L is they're very hard to do well. So most of you here probably aren't getting management accounts, or you're getting management accounts with problems. For those that are getting good management accounts, this complements GP. GP doesn't replace it. So the positives are, it's the actual profit you're going to report to HMRC. This is the official document that you're going to be submitting, which your tax is going to be based on. It's very useful for budgeting. So we're going to be speaking about budgeting later on because that's what we've got to do. And over a longer period of time, let's say a quarter or half a year or a year, those issues that I've spoken about working days and cost of goods sold, they normally wash out over a longer period. So over 6 months, the profit and loss will be very accurate. So what are the negatives? It's too late to act on. I think, if you're getting a profit and loss 4 weeks after month end, which is very good, by the way, it could in theory be 8 weeks after a particular day, and you may not actually understand whether you've had a good day or not. You can only do monthly. You can't do any less than monthly with a profit and loss. They're fundamentally harder to understand. They're just more complex documents. It could be a couple of pages long. Profit doesn't equal cash, which we're hopefully all aware of. They're possibly inaccurate because they're not using COGS. And this is a big one, uneven cost distribution. So I imagine if I took all of your management accounts, looked at all of your profit and losses, hopefully you take your staff out at Christmas and you're not tight arses. But if you do, I guarantee that bill sits in December, the whole bill. So it's a couple of £1,000 on food and beer, and you're giving it to your bookkeeper, and your bookkeeper's chucked it in December. Now, there's nothing wrong with that from an accountancy perspective, but if you're looking at performance based on a profit and loss, why should December suffer because of a once a year activity? That should be spread out across the whole year, is the point I'm making. And the other issue with profit and losses is there's going to be fluctuations just because of the number of working days. So now we're going to talk about how we actually set a target then. So to set a target, we need to learn what a budget is. So a budget is a document that companies produce to try and predict costs and sales for a period of time. It could be the next month, it could be the next year, however long. What you're trying to understand here is what's your potential output, what could your potential sales be, and what are your potential costs going to be. So a budget is quite a complex document to do in its entirety, but most of the benefit of a budget comes from just doing a cost analysis. So what we're going to learn how to do today is how do you create a cost budget? And we only need to do it for 1 month at a time. We don't need more than 1 month to do this exercise. So this is a spreadsheet that I know a lot of you are familiar with, and I know a lot of you are actually using this spreadsheet. It's free, whether you use Garage Hive or not. Just follow that link, ghlaunch.com/GP. I will be updating this in the next month or so for 23. So there'll be a new version. The number of working days will change. The payroll taxes change. So there are some changes. The layout will be exactly the same, so you can just copy and paste it into the new spreadsheet. But I will be updating the spreadsheet soon. So what this spreadsheet essentially does is you put your costs into the spreadsheet. So if you start in the top left, you've got your really obvious ones like your fixed expenses, your direct debits, your rent, your rates, etc. And then you've got your wages. So for those who aren't aware, if you're paying a staff member about 30 grand a year, they're actually costing you about 34 grand a year by the time you've paid your pension contributions and employers tax. So just be aware that even though you're paying them 30k, it's actually costing you a lot more. And if you scroll down, there's loads more areas to fill in certain costs throughout the company. Now, the way to do this and to do this well is about half a day's work. I know lots of you have done this, so I know lots of you can vouch for the way that this actually fundamentally changes the way you think about your business. But to do this, you need to print off your bank statements. I recommend at least 6 months bank statements. It sounds a lot, but you've got to put half a day aside for this. Get your last year's set of accounts. And I want you to go through every single line on your bank statements until you have found every single cost in your business for a 12-month period. Now, bear in mind, if you don't do December, you're going to miss your Christmas due. If you, let's say you pay your accountants once per year, if you don't pick that up, you're going to miss that bill. So as I said, it's not an exciting exercise, but it is so fundamentally important to do. And then going forward, you don't have to redo the whole exercise. You just keep the spreadsheet up to date. Once you've got all those costs, put them into the spreadsheet. And then there are 2 sections on the spreadsheet that act very differently to the way other people train on how to set targets in your business. So where this now deviates from the norm is that we also include loan repayments. So for those, again, I'm not teaching anyone to suck eggs, but from a financial perspective, when you buy, I'll use ADAS as an example. Let's say you buy some ADAS kit and you finance this ADAS kit. The actual cost to the business is the depreciation of the ADAS kit and the interest on the loan. So this is why profit doesn't equal cash, because you can appreciate that the depreciation and the interest can be way lower than the actual monthly repayments. So we're not interested in depreciation or interest. We're only interested in your monthly cost. What's the cash cost? So I want you to go through all of your loans, your HP agreements, any finance that you have, and you actually put that on this spreadsheet. So when we set a GP target, it's a cash positive GP target, which is very different from setting a, if we're just talking about profitability, it's a completely different way of doing it. So get all of your loans, get your monthly repayments, put them on the spreadsheet. What's cool about that is once you've done this exercise, let's say you want to reinvest in some new equipment, you can get your finance quote and put the monthly repayments onto the spreadsheet, and then you'll see what your new daily target is now. So you'll know that that ADAS kit is going to cost you £50 GP per day on your target. And once you get into that mindset, it changes the way that you start spending money, because you know that to spend money, it's outside my budget, I've got to achieve this extra bit of GP, etc. And then finally, the last box in red is called dividends and perks. And this is about, we're not in business to break even. None of us are in business to break even. You may as well just go and be employed. We're in business because we're ambitious, we've got expansion plans, or we don't want to be working every day. Whatever your plans are, you have to target for those. You have to set a target based on those plans. Otherwise, you won't set the business up to consider achieving those goals. So make sure you put on here what you want out of the business from a dividend perspective, and don't be shy with it. Any pension contributions, put them on here. Any extras that you have out of the business, like your phone contract, any cars, etc., make sure they all go onto this spreadsheet. So you can remind yourself what you're in business for. And then if you have plans to expand, you can actually put aside, and I recommend that you all budget for an amount of profit each year. So when you set this GP target, set a baseline of a required profit. In addition to your dividends, put it into this system, because that's going to force you to consider to build the business around creating a profit, not breaking even. And that is really, really important. So once you've filled all of that in, you'll see in the middle, we've got this target, this daily target, £1,700. And on the right hand side, I hope you can see, I hope it's not too small. This is for 22. You can see each month has a number of working days. Then you can see how much the target fluctuates. It actually goes from some months being 39 to some months being £32,000 GP. So significant swing because of the number of working days. Once you've filled that spreadsheet in the latest version of the spreadsheet, there's a second tab. And the second tab is all about modeling your business now. And the way that we do this is we take your potential output. So how many technicians do you have? How many hours a day do they work? What's your labor rate? What's your average parts profit? You can get that information from Power BI. And you chuck it all in the spreadsheet, and then the system will tell you what percentage of your hours do you need to sell to break even. And from my experience, if you fill the spreadsheet in and you're at 60, so this green line here represents where you should be, and the green dot represents where this business breaks even. So this is a very well set up business, because it achieves target at about 60%. And this is what I call a viable business. You think about some of the things that can affect this is you have too many front of house staff compared to technicians. You don't have enough front of house staff compared to technicians. You're overpaying or underpaying staff. Your premises is way too big, so your overheads are way too much for the number of technicians you've actually got available. There are so many factors involved in making a business viable or not viable. But you don't know if it's viable until you've done your cost analysis. Now you throw it in here, hopefully you're about 60%. 60% just so happens to be about the industry average as well, just slightly lower than 60%. But if you do come in at 60%, that means if you improve the amount of hours you sell by, let's say 15%, you can see this business goes from achieving target to clearing the target by about 110 grand a year. So that small increase in selling an extra amount of hours each day has a significant difference at the end of the day. So we're actually going to model a business together now. This business has this following setup, probably a very familiar feeling business. That's the whole point of this, is we've got a manager stroke workshop controller stroke owner, could be the owner, 2 service advisors, 5 technicians. The business owner wants to retain £48,000 worth of GP, so that's their starting point, which gives them the target of £1,705 per day. At 60% of their hours sold, they make a very modest profit and they achieve their target. Okay, but we've all experienced some of these over the last 12 months, and we're definitely going to experience them over the next 12 months. So everybody's increased their salaries. There is a shocking increase in energy bills. For those that are still in contract, count yourself lucky, but you need to start looking around because it's shockingly bad. We're talking £20,000-30,000 a year at a single location extra on top of what you're paying now. So just be aware. They've whacked the interest rate up to curb inflation. So if any of you have got any variable loans at the minute, any of you want to start financing equipment or interest, your loans, the cost of borrowing has gone up significantly. You're all Garage Hive customers, so I know you're invested. You've probably all bought equipment. You've probably all paid for training in the last 12 months, and you will do in the next 12 months. And I know a lot of you have actually increased your front of house members of staff, so your non-productive members of staff, just to, you've gone down the VI journey. You want to improve your service offering, for example. So all of these things increase your overheads without increasing the potential output. So how does that look for this? So if there is a 10% increase in overheads, which I think is the bare minimum that you've all experienced in this last 12 months. So this company is now, if you look, it's gone from breaking even or achieving target at 60% to now closer to 70%. It's actually 67% to break even. So a 10% increase in overheads, all of a sudden they need to sell 7% more hours. But I think this is much more realistic. So a 20% increase in overheads, I think we're on our way to there, and I think we will be there next year. This business now needs to sell an extra 13% of their hours every single day. Now, for those of you that have tried to increase efficiency, you know how hard this actually is. You can't do it overnight. There's so many factors involved. A lot of it stems from front of house. So if you get caught out, it's going to be very difficult to actually recover this over a short period of time. So if this business didn't improve, let's say they stayed exactly where they were, and now it's a medium-sized garage with very modest costs. If they didn't increase efficiency and they weren't aware that this was coming, they would, in a single year, go from making money to losing nearly £80,000 a year without doing anything, if they don't increase labour rate or actually change the setup of the business. So one of the ways in which this business can solve that problem is by increasing their labour rate. And again, if you think back to the spreadsheet that I've just shown you, once you know your cost, you can start modelling your business from increasing labour rate to adding more technicians. Now, I don't suggest you all close this webinar and go whack your labour rate up 23%, because it does obviously cause issues elsewhere. But let's say this business filled this spreadsheet in, they put their costs in, they understood what was coming before it actually happened, then their labour rate would go up before their costs or at the same time as their costs. So they're not actually losing money. Now you think back to my story where I explained that we got absolutely blindsided by the time the VAT came around. Let's say these costs go up in the middle of a quarter and you get to the end of that quarter and your VAT's a bit tighter to pay. We've probably all been there where for some reason the VAT felt a bit more difficult to pay than it normally does, but you manage to pay it and you just get on with it. Then an entire 3 months carry on and all that VAT money is building up in your bank account. So you've actually got cash, and it's not until you come to pay that next VAT bill that you realise just how much money you've actually lost over that quarter. And in this particular business, they'd be £40,000 worse off by the time they've realised, and that is when they're due to pay the next VAT bill. So hopefully I've managed to emphasise the importance of setting a GP target from just protecting yourself, but also if you've got plans and ambitions, You can't really achieve those without knowing what your costs are. So for any of you are sat here today and you don't actually understand what you need to be doing each day, please do this exercise. You can ring me afterwards if you want to talk one-to-one afterwards. I'm happy to do it. But I can't stress enough, there is nothing else in your business that will fundamentally change the way you run the business more than this exercise. I absolutely promise you that. And I'm not just saying, there's people in here who have done the exercise. Please speak to them. It is game changing. So to bring this all together, then there is a feature in Power BI. It's not really a bonus feature now because it's been out for a month, but these are the same slides as the blend. Essentially what this feature does, it now allows you to put that GP target into Garage Hive, and then Power BI pulls that target out of Garage Hive. You can very quickly import this data using Excel. It's very easy to fill this spreadsheet in. Lots of you have already successfully done it. This is what the table looks like. If you search for business targets in Garage Hive, you'll see this table. You export a template, you import the template, you put your target into Garage Hive. And what's really cool is you get a report that looks like this. So what you see on the right hand side is your accumulated GP, and then your accumulated target, and then a running difference between the two. So the difference between those two is either the profit you've made or the profit that you've lost. Again, think back to my story. If I had this, I never would have been caught out. And I don't know what I'd have done to stop it from happening, but I would have seen this way in advance that we're actually this gap. Why is there a gap? And this gap's getting bigger, dramatically getting bigger each day that passes. And on the left hand side, you can see you've got your day-to-day net profit or your net loss. This is not days, this is weeks, sorry. So this is a weekly view. So each week you can see your net profit or your net loss on a week-to-week basis. And that data is also available on a day-to-day basis as well. So this is on the latest version of Power BI. Install the latest version. There are quite a few other changes as well, but I think that this is probably the best one. Fill your spreadsheet in Garage Hive, and in the next update, it will pull this data in. And if you check this every day, you'll never be caught out. There's one thing I want to go back to as well, which I forgot. You only ever need to do this exercise properly then, and this is genuinely hand on heart, the exercise that I do in Lindley's at the end of every month, is we set the target for the following month. Don't just go set a target for the next 6 months. It's a really good mindset to get in that your costs will change on a monthly basis because of lots of factors. So on like 2 or 3 days before the end of the month, open up your GP calculator spreadsheet and fill in any costs that have changed. As I said, you don't need to do the full exercise again. You should be on top of your costs at this point. So let's say you've got a new phone contract or your insurance have gone up, just update your spreadsheet and then fill in the following month. For Power BI to work, you only need the next month's worth of data. You don't need anything ahead of that. It will only ever look at the month in advance. The reason why I stress that is because it's a good habit to get into, because it prevents you from setting it for 6 months and then being under the false assumption that your costs aren't going to change for those next 6 months. So please get into the habit of doing this. It's a monthly exercise. I promise you it's what I do in Lindley's every single month. So that brings me to the end of my presentation. So thank you for your time. I hope I didn't go too quick. I feel like I went really quick for that. So I hope I didn't just blow all your minds. I'll make this I saw a few of you taking pictures. I'll make this presentation available for you to download so you can go through the slides yourself. But I'll just open the floor to any questions, or if anybody wants to talk to me one-on-one, if it's something a bit more private afterwards, I will be available. So thank you. No questions? Not even from Sean?
Oh,
yeah.
Okay.
Yeah, Alex, sorry. It's
Yep.
if you're using the efficiency target calculator,
Yep.
if you've got a part-time member of staff, you just round it up and average it, I assume. Is that how you do it, or is there another way?
You can do it a couple of ways. So it depends how part-time they are.
3 days a week. So
if it's 3 days a week, and you're 5-day-a-week garage.
Yeah.
Yep. So I would times that by whatever that is as a percentage. So
Okay,
3/5 as a percentage, and then times 8 by that, and then because this is daily. So you're basically just averaging it. I've had that question quite a lot. It's actually surprising how many people have a part-time member of staff, normally an MOT tester. But yeah, that's what I would do. Find it as a percentage and then times 8 by that percentage.
Okay, cool.
Because it's just this isn't perfect fact, but it's a very good way just to model based on the averages of what the very average month will look like. It does already take into account bank holidays, and some of you may laugh at this, but we've averaged out at 2 sick days per year per tech. So whether that's accurate or not, that's what this is considering.
Okay, thanks.
So my question was on the loan repayment stuff.
Yeah.
Just to clarify what you're speaking, you're about depreciation and things like that. So are you saying other accountancy methods are taking into account your depreciation, so it almost looks like it costs you less than it really does? And you're saying you just
exactly. So actually, it's not other accountancy methods. That's how you should account. Accountancy doesn't care about loan repayments. It only cares about depreciation and interest on your loans.
Right.
But let's say you take let's say it's a 50 grand loan and you're paying it back over 1 year.
Yeah.
Obviously, the depreciation and the interest is going to be way less than the repayments. So this is genuinely why you can fail as a business even though you're profiting. Right. And this prevents you from getting caught out, because loans are great when you get all your new shiny tools, until you realize, now to pay for all these tools I need to generate an extra amount of profit each day, but actually I can't because I don't have the output available to even generate that profit each day. So now I need to employ a new technician. Now I need to pay for the tech. So it's like it just keeps you in check essentially. Okay. So yeah.
Only ever would have occurred to me to put in the amount I'm paying, and that would be it. So I never even looked at it from the other angle. So okay, cool.
Yeah, it's because we're aiming for, like I said, a cash flow positive target is definitely the place to be with this.
Cool. Thanks.
Alex, can I just ask a question on the profit? So in that orange box, you say you put in 100,000 profit. When you get to the final bit where you're breaking even and you're literally getting 500, does that mean in total you're at 105?
Correct.
Okay.
So that's absolutely right. And this is where I think it's important that you put that 100k in.
Yeah.
Because it forces you to build the business around setting the target, which is forgot about, I think, too often. Yeah.
And you might be happy to break even here because you've got 100 grand in earlier.
100, exactly right. That's exactly right. So I'm in Lindley's GP target. Often we might just achieve target or might be behind target, and I have to remind myself that there is profit factored into that. But it does, it gives you a kick up the backside and forces you on.
Cool, thank you. And just really selfishly for Ireland, I actually don't know how many bank holidays we have, but can we change it in the background, or I can just allow for it different?
I tell you what, I promise you, I'm assuming that information's available online. Yeah. I will make an Irish version. It'll be very, very simple for me to do once I've built it. We've got plenty of Irish customers now. I've never considered that. So I'll get that sorted out for you.
Look, there's no panic. This looks amazing, so it'll be grand even as it is, but thank you.
Well, it will be updated probably, as I said, for the following year, some point next month. I'll get it updated for you.
Great, thanks.
Alex, sorry, just to confirm on that, and so you actually build your profit target into the GP calculator, which is what I used to do. Well, I did, and then I've just removed it out to work out the rest of it. So I put my figures in without the profit, so that it shows me the GP. Is that just?
It's your choice, Sean. There's no.
So it doesn't actually matter. No.
Doesn't matter at all. No. So, you can do either or. I think you obviously have to know break even.
Yeah,
that's it. That's important.
That's why I did that, is to do that. But I could go back to putting my profit that I want in there and then look at it again.
Well, the good thing about this spreadsheet, once you put your desired profit in, you may be sitting at, to hit that profit goal, you need to be 80% efficient.
Yeah.
Which is impossible. It's not impossible, but you don't want your business to be required to be 80% efficient to achieve your goals, because you'll just be, you'll be fighting losing battle.
60, isn't it? 60, 70, something like that. Yeah.
That's it. Yeah. So do both. I mean, you could just save 2 copies of the spreadsheet and just keep them both running. Yeah.
Cool. No, that's fine. Brilliant.
Any other questions?
Sorry, Alex, Ollie here. If we change the labour rate halfway through the year, is there any way to account for that over the year?
Yeah, so if you talk about filling in the sorry, let me just find the slide that's relevant. This one. So because you're only ever changing the labour rate won't. Right, so that spreadsheet, let me go back to the spreadsheet. So this should, if you were to send me all of your spreadsheets at any one particular point in the month, it should either be for the current month or the following month. So historically, it's just gone. Now you can, if you want to, save a copy, save it as GP calculator September, and then make a new one for October. And then in October, you simply just update your labour rate here. So you see this, I don't know if you can see my mouse. You see this here, you just change the labour rate just there, and then it will adjust the spreadsheet for you. But it doesn't matter about the past. This is just an exercise about looking forwards. Your historic stuff will, if you fill in the reports, you'll get your historic stuff from Power BI.
Cool.
Which will be these.
No,
Alex, mentioning labour rates.
Yep.
We have a couple of different labour rates depending on whether we're doing commercials or cars.
Yep.
How do I just take an average of the two to put in there, or
well,
do I take that out?
Yeah, it can't quite be an average. So in any of your businesses, when you're setting up a garage, you'll have an amount of costs, and you'll know an amount of text and how many hours you need to sell, and to achieve a certain value of that value needs to be achieved. And if you like Lindley's, we've got a service price, we've got alignment price, we've got labour rate, brake fluid. It's all got that many different labour rates going. But so in Lindley's, we're always £5 behind our full retail labour rate is what we, in our business plan, that's what we need to achieve. And we need to sell 60% of our hours at £5 lower than our standard labour rate. It can't just be an average of two, because one of them might make up 5% of your sales and one of them might make 95% of your sales. So it's just a bit of giving it some consideration to just come up with that happy medium. But essentially, all of you here, your business will cost an amount to run per hour. And that's really what you need to be figuring out. And like I said, I base that in Lindley's very loosely on £5 lower than my full retail labour rate is where we are when we take into account trade. I know some of you do fleet and some of it's quite extreme. So, you might £45 an hour and your retail might be £65 an hour. You need to be realistic when you're filling the spreadsheet in at what you're actually achieving. And that will probably wake you up to, this isn't to bash on fleet. I know some very successful fleet companies, but you just need to be conscious of what that lower labour rate can actually do. And when you're filling in, where are we? When you're filling in this figure here, just play with it and you'll see the extreme swings it can cause.
Alex, for my labour rate there, I used in Power BI, there's obviously the rate that you actually achieved.
Yeah, that's fine.
So yeah, and like you, I think we're about 550 behind where our labour rate is as an average. So I'd use that figure.
Yeah, you can use that. That would be quite realistic. Yeah. The thing is with that is, let's say you put your labour rates up, it might not wash through straight away. So just bear that in mind. There might be some, historic jobs or quotes, etc., with the old labour rate on. So yeah, just bear that in mind.
Can I ask a question about, if we can go back to the previous slide where you've got the graph?
Yeah, this one.
Yeah. So just to get my head around this, if this was, I don't know, in a monthly view or whatever, to get historic data, so every time I input my GP target, do I set a new date like we sort of do when we update our labour rate within Garage Hive?
So it's done on a day-to-day basis because you've got bank holidays, weekends, some work Saturdays, some don't work Saturdays. So you'll see, let me just go back to this slide that shows you how to fill it. This is what it looks like. Look, so you've only got one location, so you select main or whatever the location is.
Yeah.
We've only got one type at the minute, but we're going to be introducing new targets into this. But for now, it's just GP. Then you've got your days of the month. It adds a weekday just to assist, and then you've got your.
So I physically need to do every single day, right? Okay.
Yeah. So if you do it in Excel, you can use Excel. So you just fill.
Yeah.
It's really easy in Excel. To be honest with you, if you do it directly in Garage Hive, it's a 2-minute job, once per month.
Really, that does sort of work like the labour rate one does. Every time you update your labour rate, you go in there and add the next date that you check. Yeah, yes. So it's the same principle. But
similar principle, except this is this needs every day. Because if you think back to this slide, it's got to understand the accumulated value based on the days that you work.
That was my confusion. If there was only one figure, how was it going to do that? So I couldn't work it out. Right.
Yeah, so it's day by day. Yeah.
Makes sense. Yeah.
Right, so
with that export and import on that business targets thing we have. Yeah. So are you saying that we use the magnifying glass business targets, export it, fill it out, and then import it?
Yes, so there is documentation, there's full documentation on this, but essentially fill one line in, to fill the first line, which for all you guys, I would expect to be the 1st of November, then export it, then go into Excel. Now, if you've got basic Excel skills, you'll know that you can highlight a cell, drag it down, it'll fill it all in for you, and then you just delete the ones that are on Sundays or bank holidays, etc. Save it, import, job done. Really, really quick exercise to do.
And how far in advance do you go with that?
1 month. As I tried to emphasize earlier, I would only ever budget for the following month. I've had quite a few questions around why would you do that, and it is just to get into the habit of knowing that your costs are going to change each month. And it's a really good exercise at the end of the month. Make it intentional to sit down, open your GP target, update the costs, whatever's moved, change things around, then set your following month up. In Lindley's, we don't do more than the next month ever. It's always 1 month in advance. And it's something I can't force you to do that, but I strongly recommend that you do that. If you do 6 months and you got it wrong, the difference from month 2 to month 6 could be significant losses or gains that you've actually got wrong because you've set your GP target £100 wrong per day. Times that by 6 months worth of days, it could be well out. So just 1 month in advance. And I really do like, if you I don't know if Barry or Laura are here, but they've got into a really good habit. Month end, they sit down, they go through the costs, they update their calculator, they input it into Power BI, they look at their GP against GP target, and they actually make they make a meal of it. It's a proper good month end process to have. Any other questions? If there's any in chat, no. Okay. I think that's it then. Oh no, Ollie's. Any questions?
No, it's all right, mate. No? Just to say thank you, really, mate. I can't thank you enough for sharing the intimate workings of Lindley's with us. It's
it's a pleasure.
Mega,
mate.
absolutely mega.
Hope you found it. Valuable. Like I said, this will be on YouTube. I will upload these slides. I'll make a post about the documentation to fill this in. But please, if I've blown your mind or it doesn't make sense, just ring me. I might not be able to set aside time that day, but I promise I will be able to set aside time, and I'll go through this on a one-to-one basis with you. It is genuinely my mission to get everybody to have a GP target set. It is fundamentally game-changing in every way that you run your business, from expansion, from just mitigating any risk, from recruiting. I don't understand how you can do any of that without knowing what your costs are. So yeah, thank you all for your time. I really do appreciate it. I know it's middle of the day and I know it's a really busy period for us all. So yeah, thank you guys. And that is all for today.
Thanks, Alex.
Cheers. Thanks, Alex. Cheers.
Cheers. Thank you.